Hi, I'm Steve Clapham. I'm the founder behind The Balance Sheet, and welcome to the latest in our videos. This one is about the outlook for the year ahead, 2022. Amazing that we're here already. So before I start, I'd just like to remind you, please sign up for our free newsletter, free training materials on behindthebalancesheet.com. And while you're there, don't forget, you can check out, we've got all sorts of investing courses for private investors. Our Analyst Academy has been super popular, and the price will be going up in Q1 2022. So get in now if you're watching this as I have just published it. So just looking back to what I said last year, I said, look, 2020 was an exceptional year, and I said, hopefully 2021 will be a bit more normal. The focus should be on 2022, the current year, when things will be back to normal and valuations should reflect that expectation. So I said what you should do is compare 2022 to 2019. Some companies will be reporting a higher profit, some companies will be reporting a lower profit, and your job is to identify where it's not priced in. Now, obviously, last year we had a sort of up and down year in terms of perceptions of COVID and the Omicron scare at the end of the year, but in actual fact, the markets have been pretty strong around the world, and particularly in the United States. But there are a few telltale warning signals at the end of last year that I'm going to talk about. Because what we exited 2021 was with several trends apparent. So the breadth in markets had deteriorated. And the S&P, many companies in the S&P underperformed. It was down to a very narrow group of winners, which obviously really hurt a lot of active managers. Very few active managers outperformed last year. And there was also some evidence, I think, that tech was starting to roll over. Interestingly, Cathie Wood's ARK ETF, where there were billions of dollars piling in at the top at the end of 2020, it was actually down in 2021, and it started very badly in 2022. And this will continue, I believe, because a lot of the stocks that are in that ETF, ARK has been the main buyer. It's been the main driver of the price. And in the same way that's been the driver of the price up as funds have arrived into the fund, it'll be a driver of the price down, because as people redeem those stocks, there won't be any buyers at prices for many of those stocks. There is, I also think, some evidence that rates may rise faster than previously thought. If you wind back to 12 months ago, clearly there's a perception that rates are going to go up more. But I think what's quite interesting is that bond yields aren't really fully reflecting that, or fully reflecting the inflation fears, and there's still a hope that inflation will be transitory. I think that remains to be seen. So let's just talk about 2022 and what am I thinking about. The thing I think has been overlooked or under talked about is China. It's really important. There's been very limited coverage, and I'm going to concentrate in this video on China. But before I start on China, I just want to mention some other things, because I think inflation will be a key thing this year. Obviously, there's been a lot of talk about inflation in the last 12 months, but there's been a confusion as to whether inflation is transitory or whether inflation is here to stay. I'm in the non-transitory, here to stay camp, and I think we'll see more evidence of that as we go through the year. Obviously, what you're going to see is inflation has been boosted by supply chain constraints. Those will come off, but I think the underlying trend of inflation will continue to be upwards. I mentioned growth versus value because there is some evidence that some of the tech stocks are rolling over. I don't think the stocks that I own, I don't see that they're terribly expensive, but there are some stocks which are on really stratospheric ratings. I'm thinking of stocks like in Europe, Adyen, the payments company, which has got a fantastic opportunity, but it's on $100 billion market cap for 1.35 billion euros in sales. There's a lot of hope in that price. Zoom's obviously come off. Zoom's the other one that I've been talking about, and it's obviously more than halved already. But I still think there's challenging valuation at Zoom. ESG, it was a big theme last year. It's going to continue to be a theme. It is the theme for the next decade and probably longer. And crypto, very, very popular last year. If we get rates going up, if we get a less frothy market, one of the symptoms of that will be a weaker price of Bitcoin and some of the other currencies. So some of the cryptocurrencies, I mean, I don't understand who's buying them, to be honest. I mean, at least Bitcoin, people agree that it's one of the ones to back. And my personal interest is in ETH, but I'm still learning about all that. And hopefully, once I've learned, I'll share some questions with you in a future video. Another thing to think about is the dollar. The dollar's been pretty strong, and I think that will continue because I think the dollar will be early in the rate rise cycle. So I think funds will go into dollars, but we'll see. There's two schools of thought in that. I'm in the stronger dollar camp, but I don't pay a huge amount of store on my own personal forecast because I don't know any better than anybody else. So let's just talk about China in this video. And why am I interested in this? Well, I think there's four key themes. Number one is, how do President Xi's policies pan out in relation to the tech stocks? Because they have been hammered last year. And it's quite interesting, when you look at some of these stocks that have really collapsed, I think the valuation is more interesting than it's been for a long, long time. Now, I have been quite vociferous critic of some of those companies' accounting policies. But at the end of the day, you've got to ask yourself, well, okay, the earnings may be exaggerated, but some of these are very attractive businesses. And what is the right valuation? Secondly, is the US-China relationship. And I think this is there's a potential risk here. Thirdly, and most important, I think, was what does the Evergrande fallout mean for growth and the renminbi dollar? I mean, there's quite a chance that the renminbi will continue to weaken against the dollar, or weaken against the dollar. It's not been that weak. And I think that would be in China's interest. So let me just talk a bit more about all of this. Xi's policies in tech stocks, the comments and the decision to pull the Alipay float has been disastrous for Alibaba investors in particular. And it's hit all the big China tech stocks, which have underperformed their US counterparts very, very significantly. What was very notable towards the end of last year was that Didi is pulling its listing from the US and is going to be listing in Hong Kong. And there is a strong risk that that happens to other Chinese quotes in the US, which makes it very, very risky in some respects to buy those shares, because the technical position on the US versus the Hong Kong listing may change very significantly, and we don't know that they will be fungible, right? You don't know that you'll be able to sell your Alibaba ADR, ADS, the US stock. You don't know that you'll be able to sell it in Hong Kong if it loses its listing. I haven't researched this. I must research this on Didi. But Alibaba has lost so much value that at least looks cheap relative to its history, and probably is on anything other than quite a draconian view of the future. But obviously, some of the policies that she's introduced mean that the company will need to respond effectively to new competition, because that new competition has been boosted. And for the other Chinese tech stocks, the next two factors are issues: the US-China relationship and the growth in the economy as a whole. These two factors create some risk that merit some de-rating, in my view. So the China-US relationship, I think that there is a risk that tit-for-tat exchanges could ensnare stocks like Apple and Tesla, which have very, very big China exposure. So I think if you're invested in these stocks, you should perhaps think about buying yourself some protection or give yourself some room to top up in a setback, because they could get caught in the fallout. The real risk is in China tech quoted in the US. If the SEC pulls their listings, the technical position of the shares will be awful if those shares aren't fungible. And the fact that Alibaba looks cheap relative to history won't matter. And this possibility arises that some people watching this may not be aware. There's this sort of slightly arcane technical ruling that the SEC is entitled to inspect the audits of companies that are quoted in US stock exchanges. But China will not allow the SEC to inspect the Chinese audits. Now, this is one of these situations that, there should be some diplomatic fudge, but there's a risk that if China-US relations deteriorate further, that there won't be a fudge and the SEC will just say, okay, China, quoted stocks, go back home. And that's a big risk if you're holding these shares in the US. I will check on the fungibility issue and the fungibility of Didi. I mean, obviously the stock in the US has been awful. So I'm assuming that there is a risk that they aren't fungible. But that's something I will investigate. As always with China, there's a huge amount of mystery around it. I don't speak Chinese, so it's actually very hard to do primary research. And so you're reliant on hearsay and secondary commentary, which is not, I don't feel as comfortable. And when I was at the hedge funds, we had local Chinese people that we use. So at one fund, we had a consultant in China. At one fund, I had an analyst who did nothing but Chinese stocks. She was Chinese and spoke Mandarin. So, she was our person on the ground, although she was in London. So Evergrande's fallout, I think, is the biggest risk for global growth. Obviously, we're in a booming economy. Reading the Financial Times this morning, the Rolls-Royce sales are at an all-time record. But there is this little dark cloud, small dark cloud on the horizon. I think it's always important to be aware of these dark clouds because it's only when things are really booming that people forget the risk in the stock market, and that's usually when you get a big correction. So I'm not saying that we're going to get a big correction, but I always feel the more positive things are, the more worried you should be because the more can go wrong. So the Chinese authorities have to walk a tightrope in the case of Evergrande. They don't want to encourage developers to take on as much leverage, but they don't want to wreck the property market either. If anybody, I don't imagine anybody watching this video won't have heard of Evergrande, very indebted Chinese developer, effectively bust. And there's some fallout going down the chain in other developers. And the thing about the Chinese property market, the residential property market, is it's a very artificial market because rich Chinese buy apartments and leave them unfinished in order to benefit from capital appreciation, which is inherently a risky activity because you're removing the investment from the economic utility of the asset. And if investors became concerned that developers, many of whom are like Evergrande are incredibly indebted, if they may not deliver the apartments, if people worry that the apartments won't be delivered in 2 to 3 years' time, or if they become concerned that this is not a one-way bet to future appreciation, you could have quite a big hit to demand. And in the initial reaction to Evergrande's troubles, I read one report saying that there was a 40% decline in home purchases. And if confidence doesn't return, and I'm not saying that there'll be a permanent 40% diminution in new home sales, because that would be really, really bad. But if confidence doesn't return, this has been a huge engine of growth for the Chinese economy. And they need that confidence because development's over 20% of GDP. So the impact of any sustained demand contraction would be very severe, as with the knock-on effects. It's not just steel. Obviously there's a big impact in the steel industry, and other industries, but construction itself is a big employer. And if the developers have got less cash from deposits, they're going to have less capital to fund land purchases, and they're going to need less land, which is going to be a headache for local municipalities. They rely on land sales for up to 40% of their income. The Chinese authorities, the Chinese state government has actually put in some caps on land sales and is encouraging municipalities to rely less on this source of income. But, this is all very important because the local authorities are the people that are funding these big infrastructure projects. So that would be a further impact on construction and steel demand. And that's the fly in the ointment for global growth. And, the Chinese property situation probably wasn't sustainable even in the good times. But I think there's a lot more and larger question marks today. And you think about it, if you're an international steel company, might you be at risk? Might you face a flood of cheap Chinese exports in some of your markets? The thing is, China's been an engine of growth for the global economy for much of the last 20 years. and it may not be running in all cylinders in 2022. So that may take the gloss off the boom that we're seeing everywhere else. So I've just covered China here. Watch future videos for more on the outlook for 2022. We'll be doing more market commentary in 22, more updates, more news related items. And don't forget to subscribe to the newsletter, because I'm going to be doing more on the newsletter next year, this year. So don't forget to sign up on the website at behindthebalancesheet.com. Thank you very much for listening. Please, if you're enjoying these videos, please subscribe to the channel. It really helps. Thank you.